Hello, welcome. My name is Ko Fujimoto. I am with CDH. Going to talk about pre-immigration planning. Relocation to Japan, set of your US residence. So let's get started. You are planning to move to Japan. Okay, you still have a home in the United States. There's a one critical fact that I want you to be aware. That is, be aware of the Japanese capital gain taxes of your home. Yes, you may get taxed on the sale of your US residence. Let me explain. You are moving to Japan, right? And you still have a house. But after you move to Japan, most likely you are considered a resident in Japan or a resident of Japan. Okay? If that happens, well, what happened now is you are able to sell your house, and because of the sale, you receive proceed from the sale. But this triggers few things here because you are now a resident of Japan. First, US capital gain taxes. If the sale results in a gain, and depending on the situation, you may exceed this $500,000 sale of home exemption. This is a US tax rule. Some people may have $250,000, some people may have none, depending on ownership period, usage period, and how often you used this system. Okay, so I'm not gonna get into the details, but you can easily imagine that house was on the US soil and it resulted in a gain, and you can easily understand that US government will tax you on a capital gain. Understand? However, this pitfall is you are a resident of Japan. So at the same time, the Japanese government wants to tax you because you, as a Japanese resident, sold your home with a gain. They don't care if it's in US, in England, South Africa, or wherever. Okay, so there is a Japanese capital gain tax, and there is an exclusion similar to US exclusion, $300,000, take it back, 300,000 yen, Japanese yen exclusion. That's about, I say, $230,000 maybe, given the exchange rate. So you have one sale of your house, but you have two tax bills. So this is a double taxation, and you would use a foreign tax credit to try to minimize this overlapping part of two countries' taxes. It's easy to say, it's difficult in terms of the paperwork. It is a lot of work. It's a lot of money to the accountants for sure. Okay. So anyway, so this will happen, but as always, there is always an exception. The general rule is Japanese government tax you once you become a resident of Japan. But I think I am a US CPA, I'm not a licensed Japanese tax accountant, so you should check with them. There are certain exceptions for non-Japanese or foreigners. foreigners, gaijin. I think the Japanese government will give some relief or breaks to gaijin, the foreigners. Okay, so this is what's gonna happen. So your pre-immigration planning, what you need to do is make sure you qualify for the US $500,000 exemption rule. You must be familiar with this rule so that you can take a full advantage of it if you have any gains. If you don't have a gains, like I don't, like I do, or I have no gains, so I don't really have to worry because I'm not gonna move to Japan anyway. But if I sell my house, I will have no gains, so I have no worries. But in case you have gain, substantial amount of gain, make sure you qualify for the maximum amount of this US tax exemption. Okay? And ideally, sell your home before you become a resident in Japan, right? It's so crystal clear. Once you become a resident of Japan, then they will tax you. If you don't become a Japanese resident, they don't tax you because the property is in the United States, right? So if you can do this, that will be perfect. However, if you cannot sell your home before you become a resident in Japan, prepare to qualify for 300,000 Japanese yen residential home exclusion in advance, meaning they do require some paperwork. I think the paperwork means the proof, evidence that you in fact resided in a home in, let's say, 352 Madison Avenue, Manhattan, New York, or the Apple campus next door, the Silicon Valley address, and so forth. So they need evidence, right? The Japanese government and Japanese people are very particular about the evidence and strict about the format of the evidence too. At least that's what I feel. Anyway, so instead of start worrying about this Japanese 300,000 yen residential home, exclusion, gain exclusion, worry about it now and get the necessary documentation now so you'll be ready. That's my point, okay? If one of you is a US citizen at birth, you may take advantage of a special rule of the non-permanent resident rule in Japan. I think this applies to the first 5 years of residence. I could be wrong. I am not a Japanese tax accountant, so please seek advice from the Japanese tax expert. Okay. That's all for my today's presentation, pre-immigration to Japan, and this is my disclaimer. The rules are changing every single day. We are talking about the two countries' rules, and I can't tell you every single details of the rule. You should contact with a professional accountant of both countries to make a decision. Please do not make a decision based on this 5-minute free YouTube video, okay? It's not fair. It's not fair for you to say to me that, you say that in your video, that's why we did it and we missed the tax breaks opportunity. You pay me my tax break. I can't do that, okay? I can't do that. So this is my official disclaimer. CDH, we have a cross-border family practice, and we, basically individual tax practice dealing with tax treaties and foreign tax credit, foreign earned income exclusions, and Japan-U.S. tax treaty, Japan-U.S. inheritance tax treaty. So the cross-border taxation is our division's expertise. So please, if you have any questions, and please contact us, crossborder@cdhcpa.com. If you happen to be a tax accountant who wants to specialize in this area, please contact our email too. We are welcome to have a like-minded persons in our team. So thank you very much and have a wonderful day. Take care.